Hello there, my friends. Chris Marcus here with you for Inside the Markets on the StockPulse Network. Today, excited to be joined by a new guest, Nick Rokke of Palm Beach Research. And obviously, especially with the cryptos and everything going on in the markets, I've been following Palm Beach for a little bit. And with the markets getting absolutely clobbered again today, fortunate to have Nick join us. So, Nick, welcome to the show. And how is everything going down in Florida today?
Thanks, Chris. Things are pretty good. It's a beautiful day here in Florida. As long as you ignore the markets, things are going great.
So the Florida weather is doing a little bit better than the U.S. stock indices today, it sounds like.
Yes, I'll go long Florida weather and short the stocks.
Yeah, so to dig in, obviously, last couple weeks, we've seen a lot of volatility in the stock market, again, down today. Curious just your overall take on what's happening, perhaps why it's happening now, and what you're seeing out there.
So it's kind of two things. If you're talking about the crypto markets, there's just terrible investor sentiment right now, and everybody wants to get out. So as soon as any kind of bad news hits, investors just go right for the exits, sell first, ask questions later. And the bad news this week was that the Bitcoin Cash fork was going to happen, and it's very contentious. And one guy, Craig Wright, I believe his name is just going on a power trip, and he wants to sell off his Bitcoin and go into the Bitcoin Cash and into the fork that they are forcing there. And that caused the initial drop below 6,000 in Bitcoin, which was the previous line in the sand where everyone thought there was huge support at 6,000 and wouldn't go below that. That caused the initial burst down, and that brought us about 5,300 Bitcoin. And then over the past couple of days, it's gone even further, and that's because the SEC brought about some charges on two recent ICOs, initial coin offerings. And what they said was that these coin offerings were securities and they did not register with the SEC. So it's illegal for them to do that, and they need to pay huge fines compared to what they raised. And this has every other ICO scared. And what they're doing is selling all their crypto, all their Bitcoin, all their Ethereum, whatever they raise, they're selling to raise cash in anticipation of potential legal fees if these the SEC comes out with further sanctions against more ICOs. So that's what's causing the volatility right now.
Yeah, and it's interesting you mentioned that. I have heard about the ICO issue and the SEC regulation, and it's fascinating because a lot of the regulation has been a bit vague, which creates a tricky environment, which some companies now they're saying, well, you weren't registered as a security. So how do you see that all playing out? I find often whenever there's panic selling, not all the time, but certain times that people are selling out of panic creates an opportunity where it could be good to buy. How do you see that with the cryptos? Is this an advantage you see people should be taking advantage of and a mispricing, or where do you see that heading?
Well, what it's going to do is it's going to separate the good projects from the bad projects. Mm-hmm. And we're going to see it's the good projects, they're going to survive this, they're going to do better, and they're going to thrive. And the bad projects, they're going to zero, they're going to be bankrupt, they're going to be tied up in lawsuits for as long as they can pay lawyers, really,
right,
and earn all their money. And so that's what's going to happen. And every market needs to go through this. You got to have ups and downs, and you can't just be all ups. Otherwise, you're going to have tons of just junk companies making money. So you have to have these downturns to get rid of the junk. And that's where you see the really great companies not only survive, but thrive. And that's what we're going to see. So right now, I believe it's a good buying opportunity for the established cryptos. Probably the larger ones would be where I would start right now.
Yeah, that makes sense. And similar to what I've been thinking, where I believe there's a valid use case for a lot of the cryptos that are filling a specific business need Although when I hear people say 95 to 99% of them will be worthless at some point, kind of like pets.com, I've thought that also makes sense. And in terms of some of the ones you look at, what are the things that you look for that at least are good starting points for people who are thinking about getting in and trying to separate the good ones from the not so good ones?
Well, what I tell people who ask me that is I follow the expert, and the expert at Palm Beach is Tika Tawari.
Right.
And I follow his advice for whatever he says is what I try to do. But what I look at right now is I want to find the established players, the ones that are still using, or that people are using and have a use case, and that people are still working on, like programmers are programming to make the crypto better. So Bitcoin has something like 150 developers working on it full time, I think.
Right.
And so you have 150 of some of the world's brightest programming minds working on Bitcoin, trying to improve it and make it better. And they are. And pretty soon the Lightning Network is going to come out, and that's going to allow Bitcoin to have a lot of more transactions, and it'll make it cheaper to transact using Bitcoin. And that's something to look forward to. And that's something I like to see, and people working on Ethereum as well. And also another theme we're following is what are the institutions looking at? Because really when the market moves, it's because big money moves in and is excited about something. And we see institutions setting up platforms where the big money can come in and buy, right now, Bitcoin. There's the, I think it's Intercontinental Exchange, ICE, is working on creating the backed platform, which is going to give Bitcoin futures that actually settle in physical Bitcoin. And they're going to make that available to investors in January now. And that'll be a huge thing to get a lot of people into the markets, a lot of big money into the market. And so I'm just looking to see where the technology is improving and where the big money institutions are setting up the groundwork to get in.
Yeah, and Nick, I remember when we met up in Vancouver, I caught part of Tika's presentation, and he was talking about how some of these new products will allow a lot of the funds that previously didn't really have access to get into the cryptos. I guess one thing I've been concerned about, which I think you touched on a little bit, where again, with some of the ETFs where it's traded in the futures and paper contracts, it's like similar to the gold and silver markets, where I've felt there's a disparity between what's happening with the physical and what's happening with the actual metal. So certainly one of the things in my research about cryptos that I've been warned and heard repeatedly is you want to be careful about where it's stored. You want to be careful that you actually have the Bitcoin. How is that difference with the what the ICE is launching? Are people, and I guess you said they are getting the physical, or not physical, but that they'll actually receive the deliverable. Can you touch any more on that, just so people can understand how that works, and if that's something where it's a situation like things are getting rehypothecated a lot and the Bitcoin's being sold to more than one person, or whether they really end up with a claim on that through the futures?
Mm-hmm. So the main reason why a lot of institutions can't buy crypto right now is because of the custody issue. And this is a huge deal for hedge funds and pension funds and everybody else. Before I started here, I worked in the hedge fund world for almost a decade and helping people set up hedge funds and get them going. And the one thing that we'd probably spend the most time on is who is going to be the custodian of the assets. That's very, very important. Investors want to know a third party is out there to store the assets. So like a Bernie Madoff thing doesn't happen, where he says he has these assets and doesn't really have them, fabricating trades. If there was a third party custodian, you would have found that out as soon as it happened initially. So this custodian issue is a huge thing for hedge funds and pension funds. And what Bakkt is doing is, they're one of the most established players in the markets. Like ICE is the owner of the New York Stock Exchange, and I want to say maybe the London Stock Exchange as well. Long-term established markets, a lot of credibility, and they have an established custodial relationship. So what they can do is they can be the custodian for the Bitcoin behind the contracts. And they're insured and everything, so the investors will not lose their Bitcoin if the ICE gets hacked or the backed platform gets hacked.
Right.
They're insured and they're ready to go, and that allows the hedge funds to have that custodian, that third party, hold their assets and store their assets, where before that wasn't the case.
Right.
Like right now, there's a futures contract out there for Bitcoin, but it's cash settled, which means it just takes the difference between what you entered in, what the price is at now, and they just pay out the cash based on what the price is at the time of the expiration. But this time, when the contract expires, that contract, it will, instead of being cash settled, you will get the Bitcoin.
Okay, well, that sounds good. I like when they actually have the physical settlement. And I guess in terms of one more thing, wrapping up on the cryptos, with Bitcoin, or pick another crypto if you want. But let's say things go perfectly. What's the best case scenario for Bitcoin? I mean, do you see people actually using it as currency? Is it a store of value? Let's say things went perfectly. What is their best case?
I mean, if things go perfectly, it's going to be used for both. It'll be a store of value and a currency. Right. And that's what these Bitcoin guys really want it to be. They want to have their currency, it's backed by something like gold. They're backed by this cryptographic software where it's guaranteed not to inflate away the value of their holdings. And that's the ultimate goal.
Okay.
Whether or not it happens, yeah, we'll see.
Yeah. Well, certainly there's, again, from my perspective, coming at this from an Austrian economics view, being concerned about the currencies, certainly I've been fascinated by what we've been seeing, and especially now with the stock market getting into a correction or a bear market territory, depending how you want to define it. Curious what you see happening in the stock market, if you have any thoughts on why things are dropping so much right now. And I know you also had an article recently where you mentioned some of the ways to handle volatility and mentioned some dividend paying stocks. And for all the people who are looking at the red on the board today, can you give them some insight on what the heck is going on?
I mean, there's tons of reasons for the market to be falling right now. I mean, it could just be your standard run-of-the-mill correction. A 10% plus correction happens on average once every 2 years. We're in one right now. We had one in February. It's not uncommon to have two in a year. It happened back in 2015. And, there might be a reason for it. There might not. There's a little uncertainty with tariffs. It's hard to say if that's why, or maybe they're wondering, where does the growth come from next? Like, we had a great year of growth because of tax cuts, but what happens next? Either way, we can speculate, go back and forth what's causing it, but the fact is it's here and the market's more volatile right now, and it's probably going to be for a little bit. So what do you do about that is the question we've been talking about here in the offices, and I've been bantering around with a bunch of the other analysts. And the question we get is it time to sell all of our stocks and go to cash? I don't think that's the right question to ask. It doesn't need to be a binary outcome. It doesn't need to be cash or stocks. When the markets get volatile, what I like to do is sell off some positions, maybe have a large gain in it, or take 50% of that position off the table, let the rest ride. Or if there's something I'm just not excited about as much anymore, the price action because of volatility looks scary. I sold a video game stock of mine that I have. It just wasn't acting right. And I just raised a little bit of cash. So normally I have like a 10% allocation to cash. Right now I'm probably at 30 or 40%. And what that does is it just stabilizes your portfolio a little more. Because that 40% keeps it pretty stable. So now when the market moves like 2%, it only moves my portfolio 1%. And I like that. And as it goes down, that cash gives me the option to buy some beaten down names. So I think the price action today, it's Tuesday before Thanksgiving. I think the price action was fairly constructive today. It opened low and it bounced higher. We'll see what happens. It's moving all around right now. But you see Amazon had $100 move intraday up, and some stocks.
Those tech stocks are going wild lately, huh?
Yeah, I know. They're actually absolutely going wild. But when you see a huge move up after a fall, it's a sign that maybe there was a little capitulation and maybe the worst is done. That's what I'm hoping. So I'm going to put some of this money to work, maybe after we come back from the holiday, and put in a position and, see what happens from there. But I like having the option to buy these stocks and going to what do you do to handle that volatility. I'm looking for dividend paying stocks that have performed really well. And you'll see stocks out there like, let's see, Procter & Gamble and Johnson & Johnson. They reached new recent highs. I don't think quite 52-week highs, but they're close. And, as the market was down 10%, these stocks, dividend payers are up 10%. So the consumer staple industry, which is generally a high dividend yielding industry, just thrived. It's something I've been following for a little bit, and I like the action that we see there.
Right. And it's interesting about what you mentioned with the dividend-paying stocks. Had a guest on a couple of weeks ago, and he mentioned one of the things he likes is that if you have dividend-paying stocks and you're receiving an income on those, can also be a little bit of a hedge against the fluctuation in the market prices. So even as these things are going up and down, if there's solid businesses with a solid balance sheet and earnings, that you still can be receiving income and not really be solely focused on just whether the stock is appreciating or not.
Yeah, and that's what a lot of people do. You're looking for dividend growth at a reasonable price, really. And so what they do is, like, as long as that dividend payment is steady, you're looking at something like a Procter & Gamble. I think they've raised their dividend for 50 straight years or something insane like that. That's a long time. And like, they know every year that dividend's going up just a little bit, every year, a little bit, and then you get just a little bit more on their initial investment. And that's what they're looking at. So then they don't really care about those price fluctuations that happen in the market. They can go up and down 50%, and it doesn't matter as long as they're getting their 3-4% annual dividend. Like, they're happy, they're making money, and they're living off of it. And it's that's a good way of looking at a portion of your portfolio, is have it in those dividend paying stocks.
Yeah, and especially if you have a lot of the tech stocks that aren't paying dividends, sounds like a good way to hedge and diversify what you have in there so you're not completely at the mercy of the rises and falls of the market.
Mm-hmm. Absolutely. That's the way you want to think about that.
Yeah, and perhaps last question I have for you today here. The thing that I've thought is leading to the volatility in the stock market, in my opinion, has been the rising interest rates, because certainly that puts pressure on the mortgage sector. I think about how a lot of these government and mortgage bonds are owned by the banks, and they were talking about assets that, as interest rates rise, are going to be going down in value. So I'm curious how you see the effect of the rising interest rates, whether you're concerned about that going forward, or how you feel that's going to impact the markets, and if that's connected with what we're seeing now.
Mm-hmm. Historically, I would have said, don't worry about it. And I still feel that way mostly. But what does concern me is that our interest rates were near zero for so long.
Yep.
And we've had so much easy money and so much debt coming into the system. Like, is it going to be different this time? And that's something I think we need to be aware of. It could be different this time because the scenario leading up to here is different. But generally, rising interest rates, when they start rising, it's a good thing. They're rising because the economy is strong. Interest rates don't go up when the economy is weak. Like, interest rates go up when the economy is strong. And right now, the economy is very strong. And you see that in the earnings growth. Like, 78% of companies beat their earnings estimates this quarter, 61% so far beaten on revenue. Everyone who wants a job has a job. Unemployment's at 50-year lows. And the stocks have gotten pretty cheap. Like the forward PE is only 16 right now, and that's below the average for the past 5 years.
Right.
So there's a lot of positives out there. So I'm not too worried about the interest rates yet. A lot of people talk about interest rates. They talk about the 10-year treasury. That's general, it's kind of like the risk-free rate is what they call it. It's a proxy for the risk-free rate. And it's a little over 3% right now. Historically, over the past 100 years or so, the average is 6. And I think once that gets to around 5 or 6, you can start to be a little worried. But for right now, I think we're going to see a little fluctuation in stocks as rates go up. And so that's what everyone's told in school right now is like, your rates go up, you sell. That's not necessarily what's happened in the past.
Right.
Generally, when the rates start to go up, it's time to buy. You can see a very strong correlation between rising interest rates and rising stocks. And
right.
it's just kind of, it's one of the misnomers out there. So I'm not worried yet. I will be as rates continue to rise.
Okay. And certainly be an adventure. I guess we're late November now, so we have Fed meeting in December. Should kick off quite a Christmas party. And guess they're expecting another rate increase. And I've been interested hearing how so far, even despite real estate slowing down, the Fed has indicated still all plans to go forward ahead and reduce the quantitative easing balance sheet. So certainly a lot of dynamics at play going forward. Again, I appreciate you coming on to help break some of those down today. And perhaps just in wrapping up, to let folks know where they can find more of your work, your research, and how they can get in contact if they'd like to reach you for any of your services.
Sure. I work for the Palm Beach Research Group. You can just go onto Google, type in Palm Beach Research Group, and it'll bring you to our homepage. And there you can see the Palm Beach Daily, which is the letter I write. But you got to go to the Palm Beach Research Group website first and then find the daily. Otherwise, you'll get some newspaper that's not very good. and that's where you can find what we're writing. And the daily, as it says, its name says, comes out every day, and it lets you know what we're seeing in the markets and what we think is important.
Well, Nick, I appreciate you sharing that. I appreciate you coming on the show. I know people are waking up, and reminds me a little bit of 2007, 2008, where we see a lot of these big moves and there's a lot of confusion. So again, I thank you for sharing some insight, helping people have some things to think about. Again, this is Nick Rokke of Palm Beach Research. So go check out what he's putting out there. I know you have some subscription letters, but also, like you mentioned, the free service, so people can really get an idea for the ideas you're putting out there at a time when I think people are looking for good, honest guidance. So thanks again for joining me, and we'll look forward to checking in with you again soon, my friend.
All right. Thanks for having me on, Chris. Appreciate it.